If there's one common theme you tend to see in TSX companies, it's definitely oligopolies across the board. Here in Canada, we do have many oligopolies, which are instances where you have a small group of prominent companies that essentially control an entire market, whether you're talking about financial services, with specifically the banking sector, railways, oil companies, telecoms, which is what we'll get into in this video. They do all have very oligopolistic market structures. And with telecoms specifically, the result is a complete lack of competition, both from new entrants and foreign companies that may potentially invest into the Canadian telecom market, which evidently leads to higher prices for consumers, especially when it comes to phone plans and the data aspect of those phone plans. And to illustrate this point, this chart that you're showing here, which is a part of this article by the website Consumer, which if you are interested in digging more into the industry dynamics of the Canadian telecom market, I highly recommend it. Specifically, they're focusing on phone plans here. I know some of these companies that we're going to be talking about, which are the big three, Bell, Telus, and Rogers. They also are internet service providers, but this article focuses on the phone plans, and they're looking at the total mobile service revenue per gigabyte of data provided in these phone plans. And clearly, Canada is the outlier here. The companies are earning the most revenue per gigabyte of data provided. This is where most of the companies are. So clearly, this kind of is a testament to the market structure that is the Canadian telecom market. It's dominated by the big three, again, Bell, Telus, and Rogers. And how dominant are those three companies? Well, as of this article, which was, I'm assuming, around 2019, they made up 90.7% of mobile market revenues. So, and that was $28 billion. Now, their market share has come down very slightly, but really it's been very consistent throughout this time period here. They really haven't budged. The big three telecom companies have held this market, and they've had a stranglehold on this market for a very long time. And personally, I don't really see any reason to believe why this would change. This is about as close as you could get to a true oligopoly. I mean, it's never going to meet the exact economic textbook definition of an oligopoly, but when you're talking about three companies that control 90.7% of an entire market, which is a very significant market. I mean, mobile phone plans, pretty much everyone in the modern era owns a phone and is going to require one of these plans. It's pretty close to an oligopoly. Now, one thing that was interesting, this article also went in depth on, was saying that when there is a prominent regional competitor, which there are in certain areas, they point to Thunder Bay, Manitoba, and Quebec, this has a very significant impact on prices, and it lowers prices. And here it says the Competition Bureau found that prices are in the range of 35 to 40% lower in the parts of Canada where there is a fourth competitor that has achieved a market share above 5.5%. And then areas where it's only Bell, Rogers, and Telus, those places tend to have much higher phone plan costs. And that's really no surprise. I think we all know why that is. And then the article goes on to talk about some of the reasons why that is. So for one, there's a high barrier to entry. I don't think this is a surprise to anyone. Any company that wants to get into the telecom market needs to have a ton of money. You need to have hundreds of millions, if not billions of dollars to, one, acquire licenses so you can actually get access to some spectrum so you can begin operating these markets, not to mention all the equipment and the staff you'd have to bill out. It would just be such a significant undertaking. And you're going into a market that's already dominated by these three big companies that, you know, they do have rather high switching costs, because it's unlikely that a lot of people would be willing to switch their phone plans unless they offered a significant cost reduction. So it's not exactly a great proposition to present to a potential investor in this market, or say, you know, a super wealthy investor group that could start a new company to compete with the big three. Now, one question I always had for these telecom companies before I kind of got into my research to this video was, why doesn't a foreign company like, say, Verizon in the US just come into the Canadian market and just undercut all the other companies in price? I mean, they would probably get a lot of customers if they could actually provide phone plans at a profitable price that was a significant price improvement than what we're paying now. But the reason is foreign investment is just flat out restricted, because since 1993, as the article talks about here, the Telecommunications Act required that a carrier must be incorporated in Canada. 80% of the board of directors must be Canadian, 80% of its voting shares must be owned by Canadians, and it must not otherwise be controlled by foreign interests. So foreign investment is restricted. You can't have a company, say, from Germany just come into Canada and open up shop and start providing phone services to Canadians because of this law here. And also over the years, the industry is just becoming more consolidated. Obviously, the big story that's kind of developing now is whether Rogers can acquire Shaw. So Shaw Communications would be the fourth largest phone provider in Canada. And they also own Freedom Mobile. So that would be three companies, Rogers, Shaw, and Freedom, just merging into one, which would further consolidate the industry. And then they talk about some other acquisitions that have taken place over the years here. So one was Bell acquires Manitoba Telecom Services. Manitoba Telecom Services was one of those prominent fourth phone plan providers that was leading to lower prices in Manitoba. We can see here Bell acquired them. Shaw acquired Freedom, as we just talked about. Telus acquired Public Mobile, Rogers acquired Fido, Rogers acquired Moblicity. So it's a common theme, whenever there is a up and coming fourth player in this market, they tend to just get bought by one of the big three. And in my opinion, there's also really no incentive for this to ever change. This complete lack of competition means the big three can essentially charge whatever they want. And the telecom regulator in Canada, which is the CRTC, they really haven't made much progress in changing the market structure. And without going into too many deep details here, you can understand why that is and why there's such little resistance on these companies to make them less powerful. And one of them, I think, is because Canadians rely on well-funded pensions, and a lot of these pension plans own very large shares of stock in these companies. So these companies continuing their dominance, continuing their success will determine how much money a lot of Canadians have in retirement, which is pretty significant. That's a big deal. And in addition to that, these three companies are massive employers of Canadians and specifically of high-paying jobs. So any sort of regulatory action that the Canadian government could take to threaten the market dominance of any one of these three companies, they could just counter by saying, if you do that, then we'll just lay off a ton of our employees and we're going to blame you for it, which if you're trying to get elected into office as a public official isn't exactly a great stance to take. So yeah, it's not perfect. I mean, it's really not horrible because the Canadian networks are rather reliable, especially when you compare them across the globe. But one way to make the situation a bit better is to own some shares of these companies. So if you're going to overpay for phone plans and internet plans anyways, at least you're kind of paying yourself back by being a part owner of those businesses. So in a way, it's kind of like a forced savings plan. And until we see some actual regulatory change in these businesses, which, as I discussed before, doesn't seem likely to happen in the near future, maybe it could happen at some point if there's a really radical change and a really big push for it. But as things stand, as of making this video, it seems unlikely to me. So what we're going to do in this video is we're going to go over the big three telecom companies. We'll take a look at their financial histories and we'll compare them to each other on certain facets. And then we'll do discounted cash flow valuations of all of them. I won't go super in depth on the mechanics of each discounted cash flow valuation. If you do want a tutorial on how to do a DCF valuation, I made a video on that rather recently and we used Canadian National Railway as the example. So feel free to go check that video out. It'll teach you everything I cover in this video. But I'm just going to go over all the valuations briefly and more talk about the end results of each one. So without further ado, let's actually get into the video now. Okay, so let's begin by comparing these three companies on a few just very simple metrics. All these metrics will have something to do with the discounted cash flow models that we're going to get into. We'll also have to calculate cost of capital, so we'll get into all that stuff later. I'm not going to focus so much on the specific ratios of each one, such as valuation multiples or solvency liquidity ratios, just because we can pretty safely assume that these companies are going to stay in business for the foreseeable future. Even though they are an asset-heavy business, they do have quite a lot of debt. They really should have no problem servicing that debt because they all are so profitable. But it's always good to start with a price to earnings metric just to get a general sense of how expensive the market is valuing a given stock so that you can kind of gauge the various sentiments between the individual companies. Now, you guys know me, if you've been following my channel for a while, I don't place a whole lot of importance on the earnings metric because earnings is really just an accounting calculation. It isn't always the best metric of shareholder value that's out there. but it's a good place to start to get an idea of how expensive or cheap a company may or may not be. So looking at it on this basis, we can see Telus has the highest price to earnings ratio by a pretty significant margin. And I think one of the reasons for that is if we look at their sales growth, how it's kind of panned out over the last 3 years and of the last 7 years. Over the last 3 years for Bell and for Rogers, it's actually been negative. And if we go over here, look at the financial history, this is 7 years of income statement data for Bell, and we can see it had been growing, and then it went down 3.8% in 2020. So that was likely due to, that thing that happened in 2020. And then it was a pretty similar story with Rogers, but they got hit a lot harder. They had been growing, very stably single-digit revenue growth, and then 7.7% decline. They even declined from going into 2019. But that wasn't the case with Telus. They actually remained strong. And even though 2020 was a lower year for some of the other companies, Telus actually performed pretty well. So that's why I think the market is valuing Telus a bit higher. They may be seeing that trend and thinking that Telus is doing something to capture market share. But you have to take in price and value. You have to take both into consideration. You can't just look at one company increasing sales and say, because this company's increasing sales, that means pay whatever it takes to get it. You have to look at the actual value you're getting, which is why I prefer to do the DCF model. And then if we look at operating cash flow, all these companies are growing their operating cash flow. But once again, Telus has the highest growth rates, 4% in the last 3 years, 4.3% in the last 7 years. So again, they're the stronger business there, but they do actually have lower operating margins. So this relates to operating income. Again, if we go here, we'll be looking at the operating margins, which are down here. So it's kind of been fluctuating a lot. Usually it's kind of around that 20% range, but then it dipped down a bit and went to 17.1% there. And if we take a look at Rogers, again, we'll look at the operating margin. This is a crucial metric to know for when you do a discounted cash flow analysis. So again, Rogers is a bit higher, kind of 23%. And then take a look at Bell and we'll look at the operating margins, pretty similar to Rogers, 22, 23%. So maybe this was just kind of a one-off year where it was 17%. It's not indicative of a future trend. But overall, I mean, you can clearly tell their margins have been lower than what we've seen with Bell and Rogers. So that's something to also take into consideration. And with these companies, I also want to look at how they use their operating cash flow. So what I mean by that is I'll go to the cash flow statement and we'll start with Telus here. So we'll go down here, we can see, okay, $4.5 billion in operating cash flow. How did they use that operating cash flow? How much went to capital expenditures? How much went to paying dividends? How much went to share buybacks, if there was any? Well, they actually issued shares in 2020. And that was actually a common theme I noticed with these companies. They weren't all doing that much in the way of buybacks of common shares, but they all are very high dividend payers. Especially BCE or Bell. Bell actually has a dividend yield of about, I believe it was 5.3%. The others had between 2 and 3.5% dividend yield. So if you're a dividend investor, definitely look at Bell. But of course, dividends aren't everything. So back to that operating cash flow. So $4.5 billion in operating cash flow for Telus, pretty significant growth of the last 7 years, but they used $2.8 billion in capital expenditures. And it's been extremely consistent for capital expenditures. You can see 2.3, 2.5, 2.7, 3, really hasn't gone up a lot, even though the business has expanded. And obviously a company like this is going to have a ton of capital expenditures because they have to constantly reinvest back in their networks and maintaining the quality of it. And then if we take a look at here, they're issuing debt each year and they're repaying debt each year, but the dividends they pay doesn't actually make up that much of their operating cash flow. Now, if we compare that to Rogers, we go back to the cash flow statement, we can see Rogers, $4.3 billion. So pretty similar to Telus here that did $4.5 billion. So a bit lower for Rogers, but their capital expenditures, $2.3 billion. So pretty similar to Telus there. They're paying about a bit more dividends, so about $1 billion in dividends. Again, not much in the way of share issuances or repurchases of shares. So most of the cash they're using, they're either paying dividends, using to reinvest back into their network and those capital expenditures, which is obviously something they have to continue to do. And something else I wanted to point out with Telus was this big acquisition they made, $3.2 billion. So that was a huge use of their free cash flow in that year. Okay, now moving on to BCE or Bell. And again, we're going to look at the exact same data. We're going to take a look at their cash flow statement of the last 7 years. So from 2014 to 2020, and 7.75 billion in cash flow from operations. So clearly Bell is the biggest of the three. And capital expenditures were 4.2 billion. That is historically quite high. Usually it's about 4 billion or a little bit under. So 4.2 billion historically speaking is quite high. No major acquisitions during the year, unlike what we saw from Telus. And then their dividends paid is almost $3 billion. So we can see they're using a lot of this cash flow. 3 billion out of the 7.75 they generate just goes towards dividends. And a lot of investors are going to stay invested in Bell because of those dividends, because they pay such a high dividend yield. Obviously, from a value perspective, it doesn't really make a difference whether the company decides to use their cash flow to pay a dividend or to buy back shares. We value cash flow the same way, just as it's generated from the business. And then like the other companies, they're issuing debt each year, also repaying some debt each year, and they're actually buying back shares rather consistently. So that was something that we didn't necessarily see from Rogers or from Telus here, is consistently buying back shares. So Bell, clearly the biggest and obviously the highest dividend payer. So if you're interested in a bit more safety in dividends, Bell is what you're going to want to look at. Okay, so now we'll get into the actual discounted cash flow valuations for each one. Again, I'm not going to go too into the weeds on the details. I will attach this spreadsheet that I have in front of me here, put it to the link in the description of this video. So anyone who wants to take a deeper look at what I did and, audit some of my work, if that's what you want to do, feel free to do that. But one thing I do want to point out is when I was doing the cost of equity part for BCE, I noticed that their dividend yield was actually higher than how you would traditionally calculate cost of equity, which uses the capital asset pricing model, which is when you account for the risk-free rate, the market risk premium, the company's unlevered beta as well. So because of that, I decided to use the dividend capitalization method, which is a bit different than the capital asset pricing model because it more accurately captures the cost of equity of Bell. Again, they pay a lot in dividends. So when investors invest in Bell's common equity, they're going to expect those dividends to keep coming to them, which is why I decided to use that method instead. So the way I calculate it is pretty simple. You basically just take the current market value per share, which is approximately $66 per share these days. Current dividends per share are about 3.5, and then they had historically been growing their dividends about 3% a year. Again, it's not always going to be consistently 3% a year. It might be higher some years, depending on how well they do. But over the last few years, it was approximately 3%. So that gave me a cost of equity of 5.4. And then you just kind of go through the cost of equity calculation. You calculate their interest expense, which I just very briefly approximated as taking their interest expense, dividing it by the book value of debt. You can make that calculation a bit more precise if you go more into the details, but to keep things simple here, that's just what I did. And then we got a cost of capital pretty similar for all of them. But what you'll notice is their cost of capitals are extremely low. 4.6% for Bell, 4.4% for Rogers, and then 4.5% for Telus. Now, Telus had a cost of equity that was a bit higher than Rogers, and that's just because of the beta calculation. Beta was 0.73 on an unlevered basis, 0.48 here for Rogers. So that was one of the reasons why their cost of equity is a bit higher. But overall, I mean, their cost of capitals are all extremely low. And you always want to compare cost of capital to return on invested capital. And the reason you do that is because that's how you determine if you're actually looking at a business that generates positive shareholder value, which is obviously what you need. So return on invested capital, it's around 8%. It's a bit lower for Telus, actually. In the last 12 months, it's only been 5.4%. And then over the last 5 years, about 7.5%. And Bell actually has the last, if you look at the last 5 years, they have the highest return on invested capital, slightly higher than Rogers, where Bell has 8.8%, Rogers is about 8.5%. So based on this, just this alone, I would say Bell is looking like the better investment just because of that higher return on invested capital. And it's much higher than their cost of capital, but really it's not that much different than Rogers. And Telus has a lower cost, lower return on invested capital, which for me personally, that's a metric I place a lot of importance on. So that's something I would consider, because that just proves that these two companies are just better at generating shareholder value. The greater the difference you see between that return on invested capital figure and that cost of capital, the more value they generate. Because if they can raise capital at, say, 4.6%, but when they deploy that capital and purchase assets and then make those assets start working for them so that they can start to earn money for the business, that the money that the business then earns, they're earning at a rate of 8.8%, it only costs them 4.6% to acquire it. They're just going to continually generate shareholder value into the long term, assuming they can maintain those numbers. Okay, let's get into the DCF valuation for BCE now. So I'll zoom in here and show you my assumptions. So I assume 2.25% revenue growth for the next about 6 years. I put 2021 in here, but 2021 is basically over at this point. And I'm pricing it a bit of a recovery there because that is higher than what it had been historically in the last 7 years, because their revenue did drop in 2020. So I'm assuming it will recover. I'm also assuming a constant EBIT margin or operating margin of 23%, so it doesn't change at all, which again, that's historically where it had been, especially in the last few years, it'd been around 23%. A cash tax rate of 18.59%, which I just took that from the most recent year. And then the perpetual growth rate, so the growth rate once the business goes beyond 2027, which is the last year of this model, is 0%. Which again, maybe that's not entirely accurate. Maybe it could be, I could put it at 1%, but I think because their cost of capital is also so low, in order to get a more realistic picture of the terminal value, I'm going to put it at 0%. 2020 shares outstanding was about 900 million. And then I assumed shares will grow slightly just because they had been growing slightly in the past. So what's the result of that? Again, I don't want to get too into the weeds of this calculation. Yes, I saved that for another video. They do actually have some preferred shares as well. So you have to deduct the preferred shares when calculating equity value. But if we look here, we get a fair value per share of about 66.77, and their shares trade for around $66. So we can essentially call it fair value. It's not a screaming buy. It's not super undervalued, not super overvalued either. I'd say it's about fair valued. And it's always good to, when you come to a conclusion like this, because for the most part, stocks are going to be fairly valued. Not every stock in the market is going to be significantly overvalued, and not every stock is going to be significantly undervalued. The majority of stocks will be fairly valued, based on what I can tell. So it's a good conclusion to come here, makes me rest easy at night. So Rogers, let's take a look at Rogers. I'm assuming a bit higher revenue growth there. I'm assuming the EBIT margin will be 23%, but the EBIT margin will grow each year by 0.2%. Again, that's just the trend in the historical data we saw. Cash tax rate, slightly lower than Bell, 17.5%. And then we have the cost of capital. They have less shares outstanding, and they had been buying back shares a bit more than Bell. So I'm assuming shares will decrease slightly. So we put all those numbers in, and what does that lead to? Well, Rogers is actually a lot more undervalued than Bell is. So I get a fair value per share of $92.64 at a current price per share of about $58, so 37% undervalued. So it's not necessarily in screaming buy territory at about 38% undervalued. In my opinion, really to get to that, you'd have to be 50% undervalued or more, which again, those types of scenarios are rather rare, but 38% undervalued, I think, is a pretty good deal and offers pretty good value. And I don't think these assumptions that I've put in are that optimistic. Maybe 3% revenue growth is slightly optimistic. So if we wanted to, we could say put in 2%, see how that would change things. And it doesn't really change things a whole lot. We still get 30% undervalued, even with 2% revenue growth. So based on what I've done here, it does appear that Rogers is offering pretty solid value. Now let's move on to Telus. This is the one that I think gets more attention in kind of online investing communities. So I did give them a higher revenue growth, 4%, again, just due to the fact that they've been growing historically a bit faster. But I kept the EBIT margin at 20%, which again, we looked at what the EBIT margin or the operating margin had been historically, and it was around 20%. And I also assume that it will grow at 0.1% every year. The cash tax rate, I just took that from the most recent year, 16.8%. And I gave them a perpetual growth rate of 0.5. Again, that was just due to the recent faster growth. and the fact that may be indicative of the fact that Telus is actually capturing a bit more market share, which means from 2027 on, their perpetual growth rate could actually be a bit higher. We put 0% for the other ones, 0.5% here. So they have the highest perpetual growth rate of our model. Cost of capital, and then 2020 shares outstanding, 1.275 billion shares. And then I also assumed that shares will grow slightly at 0.25% a year. So not really that much impact on the model there in the share buyback rate. So what does that lead to? Go down here. They are slightly undervalued. So I get a fair value per share of $31.67, and the current price per share as of me recording this video was around $29.5. They did have some preferred shares, so I had to deduct that in order to calculate the equity value. So, I mean, overall, based on these models, it does appear that Rogers offers the best value. And I do place a lot of importance on the DCF method when it comes to valuing stocks, because my fundamental belief when it comes to investing is it's all about ownership of cash generating assets. And you have to look at what the cash generating potential of a business is, discounted back to the present at their cost of capital. And that's what you should place more weighting on when it comes to buying or selling decisions. Now, that's just me personally. I understand a lot of people have different styles of investing, and some may not look at this method as much, but I do think it's useful to understand nonetheless. And this also highlights the benefit of using the DCF method, because it allows you to put your assumptions about a particular company to the test. You know, it's one thing to say that I'm going to invest in Telus because they're growing the fastest out of the big three telecoms, but it's another to actually build a model for each one that accounts for the various growth rates and operating margins and all the other stuff that goes into a DCF, and then actually determines which one is the better buy, which one presents the best value. Now, it's also important to note that I didn't account for the potential merger with Shaw when I looked at Rogers, just because we don't know if that's actually going to happen. You know, it's very uncertain, and it can really change the model quite a lot. So that's definitely something to look out for in the future, but just know that I didn't account for it here. So based on these DCF models that we just did, if you believe the numbers and you believe the assumptions that I put in, then I would have to conclude that Rogers appears to be the best value for your dollar as of right now. And this does make sense, because if we go back to here and look at the price to earnings ratios of these three businesses, Rogers has the lowest price to earnings ratio. And this is one way you can actually use the price to earnings ratio, not as a way of just calculating value definitively for a business, but use it as an indication that one company may be offering better value than another. And then if you determine that the companies are worth looking into a bit further, you can actually do a deeper analysis like we did here to determine whether or not that is in fact true. Now, like I said before, I hold the belief that every investment is the present value of future cash flows. And the only way to value a business is to project those future cash flows, discount them back to the present, and then determine whether or not the business is overvalued or undervalued. And as we could see from the three valuations we did, all companies seem to be trading at pretty reasonable valuations. You know, none of them are way out of whack. They're all fairly reasonable, which is refreshing to see, especially in the current market environment where it seems like everything is really expensive. Now, a big reason why these companies appear to be so undervalued based on these models is due to the extremely low cost of capital. I mean, a cost of capital under 5% is quite low. And a big reason for that, as we know, is interest rates are currently very low. Now, the Bank of Canada did announce that they do plan on raising interest rates soon, but even if they do raise them from here, they still are very historically low compared to where they've traditionally been, and that lowers the cost of capital. And also the companies generally have very low betas because they're historically not very volatile. They're very safe investments. They don't move that much. And if you were to discount these companies at say 15%, then they'd all be overvalued. But you can't really do that when you're doing a discounted cash flow. You need to determine how much it actually costs the company to acquire capital, whether it's debt or equity, and then how much return it can generate from that capital. That's what truly determines shareholder value, which again, a way to determine that is by looking at the difference between cost of capital and return on invested capital. Try not to fixate so much on earnings growth or price to earnings ratios, because those can be misleading. It is possible for a company to actually increase their earnings, but destroy shareholder value in the process. Because if they invest in a new project, even though that project may be profitable, if it doesn't generate a return that's at least the company's cost of capital, then it does destroy shareholders' value. So for that reason, I'm putting my faith in the DCF method, and I'm going to say that Rogers presents the best value as of now. But overall, these all are very low risk investments. They have high moats, as we discussed in the beginning. So there's not a whole lot of uncertainty in these investments. But anyways, guys, that pretty much does it for this video. So thank you so much for sticking around and listening. If you'd enjoyed it, then please leave it a like and subscribe if you're new. And I'll see you in the next video.